All right, so this is the stock spotlight segment, and on this segment, we're talking about one name that could be a name that you may want to consider for your portfolio. Now, this is a name that I'm personally already exposed to, so I have a little bit of a bias, but I am going to list some bull points, some bear points, and the overall risk of this position. Now, this stock is going to be ticker symbol GRAB, Grab Holdings Limited. You may have heard of this one. It got some retail hype a little while back, but now it's where I actually opened up a long, somewhere in the low fives. I'm long via equity and also leaps, and I'm going to tell you why. So in case you don't know what Grab is, let me give you a little oversight, and we'll go from there. So Grab essentially is Southeast Asia's super app, right? They offer a full suite of services, ride hailing, food delivery, groceries, e-payments, lending, insurance, so banking, across 8 different companies. Those companies primarily Singapore, Malaysia, Indonesia, Philippines, Thailand, and Vietnam. Now in 2024, it processed approximately $18 billion in mobility and delivery services, and its financial services grew from 64% year over year, which is showing a lot of strength in their rideshare app portion of their business. So that was a quick little overview, and obviously you see me reading some notes. I don't have this memorized, so stick with me here. But I do have 5 bullet points for you, 3 bear points. So we'll kind of go over that. We'll look at the chart, and we'll talk about where it could go, either which way. So 5 bullet points on Grab. Basically, right now, my biggest bullet point on it is earnings inflection and their positive free cash flow. So they just turned their EBITDA positive in 2024 with $313 million in EBITDA and $136 million in free cash flow, which is a start of showing some solid indicators of financial strength. So this is more of a growth company, but when they start to show these signs of actually bringing in money and starting to retain money and having free cash flow, which is very important, that is the point where the wheel starts to turn and they actually start to grow and be more sustainable on their own versus taking out loans, issuing offerings, diluting, however else they can generate income to at least get the ball rolling. They've had user growth and ecosystem momentum. So looking at their monthly transaction users, they've increased 18% year over year. And they actually also have a subscription program, which I'm interested in because I think subscription programs, if you're not subscribed to things that you're watching right now, you're probably not existing, because it is almost impossible to live in a first world country or maybe even a third world country and not have a subscription to something. And it is the way of the future to make money, because I'm sure some of you are paying for Netflix and don't even use it, or paying for some stupid $5 subscription and don't even use it. And that is actually very attractive to me from an investment standpoint, because it's a way for free money essentially. And they have the Grab Unlimited subscription, which helps drive more frequency to people to use their platform. Think of like how people use DoorDash and they have the DoorDash Pass or whatever. That's more likely to use that because they're like, hey, I'm paying for this thing. I get a discount anyway. I might as well use it. Same kind of thing here. Helps with the retention and also obviously cross-selling opportunities, having that Grab Unlimited subscription. They also have some regional dominance and network effects. So this is actually a huge plus for them. Building infrastructure for any business, think Amazon, any Walmart, any of these big conglomerates, right? They need the infrastructure there to run their business. They may have a fantastic idea, but the infrastructure doesn't exist. They can't make any money. And these guys have it. So they lead the market in Asia specifically by a pretty wide margin. They are 4 times larger than the next leading ride-hailing app competitor, and about 2.5 to 3 times larger in food delivery. So they're showing dominance, strong market dominance in this, what is a very big growing economy, especially if they move into areas like China eventually, or India, where there's a ton of people and they're operating in the right area. That is a massive, massive opportunity. Last 2 points. They're having pretty quick fintech expansion. So their financial arm, so remember they also do banking and insurance as well. Their digital banking and lending is growing at least, or roughly, 64% year after year, year over year revenue from a $250 million base. What's cool about this is we're seeing adaptation also improve. So people are adopting to using Grab's products, because we're seeing 36% year over year growth in deposits in banks. So people are trusting this company to leave their money with them, and they're actually increasing their deposits with the bank. Which is a really strong sign of consumer confidence. They're using the app. They're putting more money into it because they plan on using it even more and more. Lastly, they have a decently strong liquidity and balance sheet. Now, I say decently because all things considered, it's still like a growth company, right? They basically, at this point in time, have about $6 billion in cash and short-term investments, which gives a lot of flexibility. And for me as a shareholder, minimizes my risk of potentially getting diluted via an offering, which is what you always want to look out for with these kinds of names that are growth companies, because they need to have money to survive. They might look at you and go, hey, you're a piggy bank, give me more money via an offering. And in general, their debt is fairly low, which is a great thing to see. So for a growth company to have pretty low debt and to sit on a decent amount of cash, that's very important. It's so important that recently they launched that $5 million buyback program. So they're buying their own shares at this price. Why shouldn't you? Just saying. They're showing confidence in their company. They're buying it back because they think it's undervalued, which is probably the best reason to buy, or one of the best reasons to buy a company. If the insiders look at a company and they buy more shares, they're doing that for one reason, because it's undervalued. Why do people sell? Many reasons. You're buying a house, you're having a child, whatever. You need liquidity, you need money, you sell stock, right? But why do you buy? Well, you buy because you think it's going to appreciate in value. You don't buy to lose money. No one buys equity to lose money, and they're buying equity, which is always a bullish thing to look at. A little bonus, they have some AI-powered tools, so that's kind of newish. It's rolling out. That could help with user experiences. That could help expand their margin a little bit. They could also lower their overhead, depending on how they're using those AI tools. They could reduce labor somehow. So that's something you want to just keep an eye on. That could be a catalyst. So if you're someone who likes an AI play, I'm not saying this is an AI play, but something that could be an AI play in the future, or at least AI implementation. Now, I did say I'd show you guys some risk factors. So I have 3 risk factors that I came up with for Grab. The first one being the premium of their valuation. So currently at stock price at $5.36, it's moved up pretty decently the last few days, actually. It's trading roughly to 7 to 8% forward sales, which is a little lofty. It really depends on what you're looking at. And this is uncommon for growth companies. The risk here with that is that when earnings come out, if there's earnings misses or the growth takes a dip, specifically the growth, because people ignore forward sales and they ignore current ratios and stuff like that for growth, because growth is potential and the market's forward looking, right? If growth slips, then it may take a hard hit. So you got to keep that in the back of your head as a pretty decent risk factor, all things considered. But that's no different than any other growth company out there right now. That is a pretty common thing when evaluations get lofty for these kinds of growth companies. Now, the other, 2 more risk factors, regulatory and competition headwinds. Like I said before, they have a pretty strong grasp on market share right now. So I'm not too worried personally about competition headwinds. But it is something to consider, especially if we see other rideshare apps or other food delivery apps or whatever that are established, a la an Uber or a DashPass or whatever, move into those markets. That could be a risk. It could also be a benefit because those companies could maybe buy out Grab. Maybe they don't want to go through all the effort and they just want to buy Grab. Maybe they do that too. Food for thought. But they do currently have a merger going on with GoTo. It's another like delivery app that primarily operates in Indonesia. So that merger is baked into the price right now. The market's expecting the merger to go through. If there's delays in the merger or certain conditions pop up to delay Grab's expansion or the ability to expand with GoTo and actually get the merger done, or the acquisition, I should say, that could harm growth. And remember what I just said about growth? Growth is a major catalyst for this company, so that could be a major risk factor because that could impact the ability for this company to grow. Lastly, and most importantly, it really depends on their execution. So it really depends on if you trust the CEO, if you trust the company's vision, all that kind of thing, which is a personal decision you have to make. If you move beyond profitability with EBITDA, they are not at the point where they're making GAAP profitability. So the difference between EBITDA profitability and GAAP profitability is very big. So GAAP is accounting based, EBITDA is not. EBITDA shows your earnings before income tax, depreciation, and I forgot the A. And GAAP is showing your earnings after all that, right? So it's showing the ability that your company can make money after we take out every other bill, essentially. Think of it as like your net profit, right? So, gross profit and net profit. Think of your GAAP as your net profit to make it very simple to think of. So I guess it's more about, do you believe that they can turn a net profit, long term? Currently, obviously, it remains a challenge. As I said, they're a growth company. But if they fail to deliver in this area, where so far they're on a pretty good track. They're looking like they're pretty good, but if they fail to deliver in this area, that could be a strong bear catalyst for this company. So ultimately, your bull case is going to be a continued EBITDA growth, because that EBITDA growth will eventually roll over into GAAP profitability, like we just talked about. They're a fintech company looking to scale, right? So they're going to look to grow, move into fresh new markets, new areas, which would give them obviously more money, more market share. And their current market dominance. They have a strong hold on their current market, right? They're bigger than their competition. Can they hold on to that? We will see. But for the bulls right now, that is something that you could look at as an area of confidence because of the fact that they have that market dominance where they currently are, which I like because it gives them the ability, when you're so comfortable, as long as you don't sleep on it, meaning you don't rest on your laurels is a good phrase to use. You don't forget about where you're so dominant. So if, let's just pretend they have 90% market domination in Indonesia. I don't know the exact number. Let's pretend it's 90%. And they go, okay, let's go attack India. But they ignore Indonesia and they also fail at India. So now their market domination in India maybe their market share goes to 10% and they failed in India. Then you've got a losing proposition. So as they expand, you're going to want to watch those numbers to see if they can hold on to their current market share as they try to expand. That's going to be very important. And to summarize for your bear case, you could have regulatory delays with the merger, so that could be a risk. Competition is there. I'm personally not too worried about that, but again, it would be irresponsible if I didn't list that as a possibility. And finally, and then the most important piece, is the failure to eventually deliver that GAAP profitability. So they're making money right now. Can they actually turn a net profit ultimately? That's what I would look at. So why don't we look at the chart and kind of see what I like about it from a technical standpoint. So technically speaking, and maybe a little rushing here, but I was watching this downtrend here on the weekly, on the daily, whatever you want to use, starting at 11:22, then it tapped again, 2:21, then again on 6/6, and it's currently breaking out on the week, which means you're not too late to the party if you want to join the party. You may overpay a tiny bit, but overpaying is relative depending on what your price target is, which we'll talk about here in a second. But I was watching this downtrend for a break, and as I said, I got in around like low fives. I'm exposed long via 5.5 call leaps and also equity. Looking for this breakout, which it looks like we're going to have. Looking at the daily chart, you got decent MACD here, flipping green on higher volume on that break, which is very important. You do have earnings coming up on the 30th, so that's going to be a big catalyst, obviously, on if it's going to be a bullish or bearish thing. Earnings are always a crapshoot, so to speak. So anything can happen with earnings. Anything can be said that can help or hinder the stock. So it is a risk factor there. So be mindful of that. But looking at the weekly and the monthly, this looks solid. You've got MACD flipping over again here. Solid bull momentum with a 61 RSI. Decent volume again on this break, which you want to see. You're above all your EMAs and MAs. You actually wick the EMA on the weekly and you're breaking above that key level, this downtrend. Super, super, super important weekly candle. And today, especially, I personally want to see this candle close basically like this. Closes higher, great, but basically going to close like this on the week. Looking at the month too, which this is a little dirty because I got so many lines here. It's looking really, really good. Essentially breaking 572, which you're about 30 cents off from the current price action. It's air. There's not much up here. You do have the red SAR also, and if you watch this program, you know I love the SAR indicator. And when a monthly SAR breaks, I love when that happens. So we do have the red monthly SAR here. That number currently is 558 on the month. So getting that break as well could lead to some more bullish upside on Grab. Now, I do want to highlight that this is a bigger company. So don't look at this just because the stock price is low, that it is like a micro cap and it's going to move super quick. Could move quick, but this is actually a pretty big company. 22 billion, so not small by any means, but doesn't mean it can't appreciate very quickly, especially for a fintech company, right? Especially for one of these companies that focuses on in general, fintech, it's a super app, so it's got its arms and tentacles and everything. These companies tend to have much, much higher evaluations just from a market cap standpoint. It wouldn't shock me to see this company within a year, and I'm going to say this conservatively, 50 to 100 billion. That would put the stock price roughly between $10 to $20, so big upside potential there on this name, at least in my opinion. Looking also at the monthly here, there's so much volume down here that your volume profile is non-existent. So the IPO, for this company was around 1189. You're at 541. Obviously, when you get up here, you're going to hit some level of resistance, but that still leaves you a decent upside here. If you're looking at risk to reward in general, which let me turn all my doodles back on. If you're looking at risk to reward in general on this name, you could easily risk, even if you want to keep it simple, at like $5 as a stop. So 490-ish, if you want to give it a little bit more headroom. You're risking about a 50-cent drawdown, and ultimately, if you're shooting for 10, which is still below its IPO price, at least almost 100% markup. So your risk to reward in that scenario is about 5 to 1 on equity, right? Decent risk to reward, great chart. These are the plays I love to share with you guys because they offer fantastic risk to reward, especially if you're moving on equity or like a leap contract. Now, what I'm looking for most interestingly enough, I mentioned the top of that level, that 572. That is the localized high on the month here back in, what was that? 11/29/2024. So we haven't been to that level in almost 2 years. So breaking that is going to be massive for this name, and it is only 30 cents away as of today. Now, that isn't going to be without some risk and without some difficulty. It does have support, or I should say in this case resistance, at 552, that kilo at 572, and I would look for 591 for confirmation. So if you're one of the people who want to be a little bit more risk off, especially with earnings coming up, you may want to wait for a break of 591. If 591 goes, then this thing's rocket to Russia. It's going. We're moving. 661's next price target. After that, 764, 822, and then you're getting into the 10s. Easy. This could be one of those names that you buy now with equity. And if we do get this 572 break and it melts through these levels, which I think it would move pretty quickly, and earnings coming up could be that catalyst. They could say fantastic things on their earnings call. This could be the kind of company where if you accumulate it now, for one of the smarter ones than me, accumulated down here in like the $2-3 area, that you could ride shares on this company for quite some time. I think there's a good chance for this company to grow quite a bit, especially in the area in which they operate. They could expand their market domination and moving into those other areas of the market, especially with them operating in Asia. They may eventually have tentacles to get into even India or China. China's a little hard, obviously, but India is a possibility, Middle East, etc. And there, like I said, there's not a lot of competition out there, so that's why I like this name. And you could sit on a name like this pretty comfortably, especially once it gets over 10, as like a longer term hold. So I do like this name quite a bit. Now, again, I know I sound very bullish because I am, but I also don't want to minimize the fact that this isn't without its risk. It is a growth company. It doesn't turn a profit, at least net profit, at this point in time. So that is risky in itself. But the risk to reward, as I highlighted here, at least looking at the technical levels, you're risking 5 to 1 on equity. Pretty solid. As long as you're making an educated decision. I love Grab for the long term. And if you love Grab, let me know in the comments down below what you like about the company, what you hate about the company. And if you like this video, don't forget to like, share, and subscribe. Thanks.